Hello, welcome to my YouTube channel. In today's video we will be talking about maximizing returns, minimizing taxes, effective tax planning strategies for investors. As an investor, you probably know that taxes can eat into your returns. However, with a solid tax strategy, you can maximize your profits and minimize your losses. Tax planning can seem daunting, but it's an essential part of investing. With the right strategy, you can reduce your tax liability and keep more of your hard-earned money. In this video, we'll cover some effective tax planning strategies that can help you optimize your investment returns. From understanding tax-advantaged accounts to harvesting tax losses and taking advantage of tax credits, we'll provide you with all the information you need to make informed decisions and minimize your tax bill. So, let's dive into the world of tax planning for investors and learn how to maximize your returns while minimizing your taxes. Understanding the importance of tax planning for investors. First and foremost, tax planning allows investors to legally reduce their tax burden. By taking advantage of available deductions, exemptions, and credits, investors can significantly lower their taxable income. This, in turn, leads to a reduction in the amount of taxes owed, leaving more funds available for investment or other financial goals. Moreover, effective tax planning helps investors make informed investment decisions. By considering the tax consequences of various investment options, investors can select strategies that align with their financial objectives while also minimizing tax liabilities. Understanding how different assets are taxed, such as capital gains or dividends, enables investors to structure their portfolios in a tax-efficient manner. In summary, understanding the importance of tax planning for investors is crucial for optimizing financial outcomes. By minimizing tax liabilities, making informed investment decisions, maximizing returns, and maintaining compliance, investors can effectively navigate the complex tax landscape and achieve their financial goals. Different types of taxes that affect investors. Capital gains tax. One of the most common taxes that investors encounter is the capital gains tax. This tax is applied to the profit made from selling an investment asset, such as stocks, real estate, or mutual funds. The rate at which capital gains are taxed depends on various factors, including the holding period of the asset and the investor's income level. By strategically timing your investment sales and considering tax-efficient investment vehicles, you can minimize the impact of capital gains tax on your overall returns. Interest income tax. Interest income earned from investments such as bonds, certificates of deposit, CDs, or savings accounts is subject to income tax. The tax rate on interest income is based on the investor's overall income and can vary accordingly. It is essential to consider tax-efficient investment vehicles, such as tax-exempt municipal bonds or tax-advantaged retirement accounts, to reduce the tax impact on your interest income. Estate tax. While not directly affecting investment returns, estate tax is an important consideration for investors who plan to pass on their wealth to future generations. Estate tax is levied on the value of an individual's estate at the time of their death. By implementing proper estate planning strategies, such as establishing trusts or gifting assets during their lifetime, investors can minimize the estate tax burden on their heirs and ensure a smooth transfer of wealth. By understanding the various types of taxes that can impact investors, you can proactively incorporate tax planning strategies into your investment approach. Consulting with a knowledgeable tax advisor or financial planner can provide valuable insights and help you navigate the complexities of tax laws to optimize your investment returns while minimizing your tax liabilities. Utilizing tax-advantaged investment accounts. One popular tax-advantaged investment account is the Individual Retirement Account, IRA. With an IRA, investors can contribute a certain amount of money each year, and those contributions may be tax-deductible. Additionally, the earnings on investments within the IRA grow tax-deferred, meaning you won't pay taxes on them until you withdraw the funds in retirement. Another tax-advantaged investment account is the 401k plan. This is typically offered by employers to their employees as a retirement savings option. Contributions to a 401k are made on a pre-tax basis, meaning they are deducted from your paycheck before taxes are taken out. This reduces your taxable income and can result in significant tax savings. For investors looking to save for education expenses, a 529 plan is an excellent tax-advantaged option. Contributions to a 529 plan are made with after-tax money, but the earnings on investments within the plan grow tax-free. And when the funds are used for qualified education expenses, the withdrawals are also tax-free. This can provide substantial tax savings for families saving for their children's education. By taking advantage of these tax-advantaged investment accounts, investors can lower their tax liability and potentially increase their overall investment returns. It's important to consult with a financial advisor or tax professional to determine the best strategies and accounts for your individual situation. Maximizing deductions and credits for investment-related expenses. One key deduction that investors should be aware of is the deduction for investment expenses. This deduction allows investors to deduct certain expenses incurred in the process of generating investment income. These expenses may include fees paid to financial advisors, custodial fees, subscription fees for investment publications, and even travel expenses related to investment activities. By carefully tracking and documenting these expenses, investors can claim them as deductions on their tax returns, thereby lowering their taxable income. In addition to deductions, investors should also explore the various tax credits available to them. For example, the Retirement Savings Contributions Credit, also known as the Savers Credit, provides a credit for eligible individuals who contribute to a retirement account such as an IRA or 401k. This credit can directly reduce the amount of taxes owed, providing a valuable incentive for investors to contribute to their retirement savings while enjoying the tax benefits. Furthermore, investors should consider taking advantage of tax-advantaged investment accounts such as a health savings account, HSA, a 529 college savings plan, or a Roth IRA. These accounts offer tax advantages such as tax-free growth, tax deductions for contributions, or tax-free withdrawals for qualified expenses. By strategically utilizing these accounts, investors can optimize their tax planning and maximize their returns. It is important for investors to stay informed about the ever-changing tax laws and regulations. Consulting with a tax professional or financial advisor who specializes in tax planning can provide valuable guidance and ensure that investors are making the most of available deductions and credits. By effectively maximizing deductions and credits for investment-related expenses, investors can significantly enhance their after-tax returns and achieve their financial goals while minimizing their tax burden. Managing capital gains and losses for optimal tax outcomes. One approach to managing capital gains and losses is through tax loss harvesting. This strategy involves selling investments that have experienced a decline in value to offset capital gains realized from other investments. By strategically timing these sales, investors can reduce their taxable income and potentially lower their tax bracket. Another important consideration is the holding period of investments. Long-term capital gains, which are generated from investments held for more than 1 year, are typically taxed at a lower rate compared to short-term capital gains. Therefore, investors may opt to hold onto their investments for longer periods to take advantage of these preferential tax rates. It's also important to consider the impact of capital gains distributions from mutual funds. Mutual funds are required to distribute capital gains to their shareholders, which can result in taxable income for investors. By carefully selecting mutual funds with low turnover rates or considering tax-efficient investment vehicles, such as index funds or exchange-traded funds, ETFs, investors can potentially minimize their exposure to capital gains distributions. By implementing strategies such as tax loss harvesting, considering holding periods, being mindful of capital gains distributions, and utilizing tax-efficient asset location, investors can optimize their tax outcomes and potentially enhance their overall investment returns. We hope you found our video on effective tax planning strategies for investors informative and helpful. Taxes can significantly impact investment returns, but with the right planning, you can minimize your tax burden and maximize your profitability. By implementing the strategies outlined in this video, you'll be well on your way to optimizing your investments and keeping more money in your pocket. Remember, it's essential to consult with a qualified tax professional to ensure these strategies align with your unique financial situation. Start implementing these strategies today and watch your investment returns soar while keeping your taxes in check. Thanks for watching. Don't forget to like my video, comment and subscribe to my YouTube channel, and also don't forget to turn on the notification button for more videos.